Thanks, Gordy, and good morning, everyone. Our underlying profit of $242 million is an increase of 6.6% on last year. Our reported IFRS profit, which includes the unrealised fair value movements on investment property, was $265 million, down 19% on last year. This reflects a $173 million decline in unrealised fair value movements due to the changes in valuation assumptions related to COVID-19. CBRE, our property valuers, have reduced its near-term growth rates to reflect an expected decline in the property market due to COVID, and also softened its discount rates to reflect the increased uncertainty at a macro level. During the year, the New Zealand Government decision to reintroduce tax depreciation on buildings has reduced the deferred tax liability, and together with an increase in the recognised tax losses, has resulted in a $93.6 million increase to the reported profit. We booked a record number of sales in the year of 1,436 units, which is a 16% increase on last year. Our operating cash flows are a record $449.8 million, up 12% on last year. Also pleasingly, our cash receipts from residents were $1.13 billion for the year, and that's also up 12%. So we've benefited from cash collections at some high-value villages and from the increase in our resale volumes. We had strong cash flows throughout the year, and this has allowed us to invest a record $711.4 million in new villages and care. Our investing cash flows were spent as follows. $497 million was spent on building new villages, $101 million was spent on land, supporting a land bank of 6,595 units and beds, $30 million on bed licences in Victoria, $39 million was invested in upgrading our existing villages to further enhance the resident experience and the care we provide, and $44 million was invested in a range of projects, which include the development of the next stage of system integration and technology, along with some new kit for our construction sites as we ramp up our build program. With such a major investment during the year, our working capital debt has increased to $1.7 billion, as we are now building across 12 sites, and we've also significantly lifted our investment in Victoria. We regard it as productive debt. We invest the bulk of it in new villages, where we recycle capital, and this establishes a growing tail of recurring cash flows. We have a strong financial position with total assets of $7.68 billion, which is up 15% from March 2019. We continue to have very supportive banking partners, and our syndicate of 7 banks understand our growth plans and strongly support us. Our debt to debt plus equity ratio is 42.6%. Our bank facility has lifted to $2.3 billion, with more than 90% of this having a tenor of 3 or more years. We're continuing to see the benefit of the developments being concentrated in high-value centres, and our development margin for the year is 27%, which is higher than our target range of 20 to 25%. The resale bank of gains still to come on our existing portfolio currently stands at $856 million. So this is the amount of resale margin we would crystallise today based on current prices. These pent-up gains mean we can expect our resale earnings to keep on growing even if the housing market was flat for several years, because volumes will increase as our villages mature. Deferred management fees also reset to these new price levels with each resale, and so this creates a compound effect. Our resale volumes in New Zealand increased by 10% over the year, while the volume in the wider New Zealand market was up just 1.8%. Demand remains strong, with only 127 units, or 1.7% of our portfolio, available for resale at the end of March. This represents a little over 1 month's vacancies, and is a solid achievement if you consider the significant momentum lost in March due to COVID-19. This demonstrates the continued appeal of a Ryman village. Demand for the care we provide remains very high, and we closed the year with occupancy at 98%. The aged care sector in general is averaging only 87%, so we are significantly outperforming the market. At the end of March, we had a significant amount of unconditional sale contracts for new units, and this totaled $337 million. This is the highest amount we've ever had, and this time last year, the number was $273 million. The majority of this will be collected over the next 12 months as construction stage is complete. However, some of these settlements won't occur until the next financial year, in line with the build program, so it shows the strong forward book we have. This has given us a very strong basis for which to restart our significant build program. Affordability of our units is something we continue to monitor closely, and our residents in Auckland and Melbourne free up significant amounts of capital when they move into a Ryman village. In fact, property prices in Auckland would have to drop 18% at our developing villages before residents stopped freeing up capital, and 30% in Melbourne. It is obviously early days, but the housing market seems to be holding up in both countries we operate, with more resilience than most commentators predicted. We have the largest service department portfolio in the sector, with approximately 30% of our retirement village portfolio being service departments, and these are priced even lower and are a purely needs-based decision. What triggers our ability to grow is simple: our model of recycling capital at each village. Since listing in 1999 and raising $25 million, we have now invested $4.4 billion in our portfolio and paid out a growing dividend stream to shareholders of more than $920 million, but we have never had to raise any new capital. And as Gordy mentioned earlier, the importance of what we do for residents is higher than ever. To give you a sense of how we're going, just on the resale front alone, since the beginning of May, we have transacted 131 resales, which is higher than the same period last year. We're also seeing residents settling their homes in an orderly fashion as restrictions have come off, and in the last few weeks, we have seen over $60 million of settlements. It's also reassuring to know that our profits will continue to lift as our villages mature. So what this means is that we would expect our profits to lift by approximately $100 million due to the increased resale volumes and deferred management fees on our existing portfolio. In addition to this, our land bank of 23 sites is expected to contribute capital sums of a further $4.3 billion. And so if you assume an 8% return from the deferred management fee in resales alone, it'll generate an additional $350 million of recurring profits each year. So this excludes the development margin, of course. There's obviously a lot of water to pass under the bridge, but we thought it was important to paint a picture for you about what the land bank could deliver in terms of value, and we don't intend to stop there. We've got a lot of future growth ahead of us, and we've come through a time where what we do has really been valued by the people we look after. So thank you very much, and over again to you, David.